How interest rates impact the housing market. Interest rates have a significant impact on the housing market in a number of ways. Interest rate changes have a big influence on decisions made by investors, sellers, and homebuyers. This investigation highlights the complex relationships at work as it explores some of the major ways that interest rates influence the housing market. Number 8. Mortgage affordability. Interest rates on mortgages have a direct impact on borrowing costs. Many prospective buyers find it more difficult to afford their home loans when these rates rise because they result in significantly higher monthly payments. For instance, the monthly payment on a $300,000 mortgage may increase by hundreds of dollars if the interest rate is raised by 1%. Buyers may have to modify their budgets due to this increased cost, which may restrict the quantity and range of properties they are able to look at. The monthly payment for a $300,000 house with a 4% interest rate would be about $1,432 principal and interest only. This payment increases to $1,610 if rates rise to 5%, a $178 monthly difference. That adds up to tens of thousands of dollars in interest over the course of a 30-year loan paid. Many buyers are priced out of the market by these increased expenses, particularly first-time and lower-income buyers who have more constrained budgets. Because fewer people can qualify for and afford the monthly payments on available homes, reduced affordability results in decreased demand. The entire housing market is cooled off by this dynamic. Number 7. Buyer demand. One of the main factors influencing the housing market's activity is the correlation between interest rates and buyer demand. A rising rate makes financing a home more expensive, which makes many prospective buyers reluctant to enter the market. They might worry that as rates rise, their monthly expenses will increase even more. Fewer homes are sold as a result of the decreased demand because buyers wait to buy until interest rates drop or stabilize. In contrast, as rates decline, borrowing becomes more accessible and frequently leads to a spike in the number of buyers entering the market. Due to buyer competition brought on by this increased demand, home prices may rise, particularly in sought-after neighborhoods with low supply. Customers keep a close eye on interest rate movements, and even slight increases can have a discernible effect on their propensity to purchase. Number 6. Home prices. Interest rate changes on mortgages have a big impact on home prices. Home values stabilize or decline as rates rise because affordability declines and demand frequently declines. It's possible that prices have driven away buyers from the market, particularly in places where prices were previously rising quickly. For instance, the total interest paid over the course of a 30-year loan can increase by more than $100,000 if rates on a $400,000 home rise by 1%. Numerous consumers are compelled by these increased expenses to reduce their budget or postpone purchases entirely. On the other hand, when rates decline, affordability increases and demand from buyers rises. Prices may rise as a result of this buyer competition, particularly in markets with low inventory. Although rates don't always have an immediate effect on prices over time, lower rates tend to increase home values while higher rates tend to put them under pressure. The local market determines how much of an impact there will be. Generally speaking, less price fluctuation occurs in more affordable areas than in expensive ones. Number 5. First-time homebuyers. Mortgage interest rate fluctuations especially affect first-time homebuyers. For their first home purchase, these buyers typically have more limited funds and depend on advantageous financing terms. It may become more difficult for first-time buyers to qualify for loans or make the monthly payments when rates rise due to the higher cost of borrowing. For instance, the monthly payment on a $250,000 mortgage may increase by more than $100 with a 1% rate increase. This may result in a sharp decline in the number of first-time buyers, which would further cool the housing market as a whole. Conversely, lower rates encourage this group of people to enter the market, which boosts demand and supports stable home prices. In high-cost markets where even slight fluctuations in rates can price many out of the market completely, the effect of rates on first-time buyers is particularly noticeable. This group is frequently the focus of policymakers because their involvement is essential to a stable housing market. Number 4. Investment activity. Decisions about real estate investments are also heavily influenced by interest rates. Increased rates make financing real estate more expensive, which could lower investors' profit margins. When borrowing costs are high, they might discover that the returns on rental properties decrease, which would prompt them to look for other investments. For instance, the monthly payment on a $500,000 investment property could increase by more than $250 with a 1% increase in rates. This increased expense can reduce the viability of deals by eating into cash flow. Lower rates, on the other hand, increase the appeal of real estate investments since they lower the cost of financing. More efficient capital allocation by investors increases demand for residential and commercial real estate. Rates have a particularly big influence on investment activity in high property markets because even slight fluctuations in rates can have a big impact on the financial calculation. A healthy housing market depends on investor participation, so changes in interest rates may have repercussions for pricing and inventory levels. Number 3. New construction. The new construction sector is also impacted by changes in interest rates. Builders may become more hesitant to start new projects when borrowing costs increase because they expect lower buyer demand. This hesitancy may cause new home construction to slow down, which over time may result in a shortage of available housing. For instance, the monthly payment on a $300,000 construction loan could increase by more than $150 with a 1% rate increase. Projects become less feasible as costs rise, particularly in industries with narrow profit margins. In turn, a decrease in supply may put upward pressure on home prices, especially if demand increases as interest rates fall or stabilize. Rates have a particularly large effect on new construction in high-cost markets and during times of sharp price appreciation, when builders might be more likely to put off projects until things get better. Although they may take some time to manifest, rate changes on inventory can have a substantial impact on the housing market. Number 2. Rental market dynamics. There may be a surge in demand for rental properties as a result of rising interest rates, pushing some prospective homeowners into the rental market. Many people and families may decide to put off purchasing a home and instead choose to rent as mortgage rates rise. When demand exceeds supply, this change may lead to a more competitive rental market and higher rents. In response to this increased demand, landlords might decide to raise rent, which would further affect tenants' ability to afford. For instance, the monthly payment on a $300,000 mortgage could increase by more than $150 with a 1% rate increase. In particular, for those who are already living on the edge of affordability, this increased cost may drive many prospective buyers into the rental market. Rates have a particularly big influence on the rental market in high-cost areas with low inventory, where tiny adjustments in rates can have a big impact on the balance between supply and demand. The relationship between interest rates and the rental market can present difficulties for landlords as well as tenants, which affects the community's total affordability of housing. Number 1. Market sentiment. Interest rates have a big impact on how consumers feel about the housing market. A more cautious approach to home buying may result from prospective buyers perceiving the market as cooling or becoming less favorable for investment when rates are high. A self-fulfilling prophecy could result from this shift in sentiment, whereby fewer buyers lead to fewer home sales and possibly lower prices. For instance, the monthly payment on a $400,000 mortgage can increase by more than $200 with a 1% increase in rates. Many buyers may be discouraged from entering the market by this higher cost in addition to the impression of an unfavorable market. On the other hand, low interest rates can boost consumer confidence and entice more people to purchase. This upbeat attitude may increase demand, which might raise prices and lead to higher sales. In times of rapid price appreciation or economic uncertainty, when buyers may be more sensitive to changes in financing conditions, the impact of rates on market sentiment is particularly noticeable. In conclusion, interest rates have a significant impact on the housing market, influencing demand and buyer affordability, as well as property values and investment activity. Navigating the real estate market requires both buyers and sellers to have a solid understanding of these dynamics. If you like our video, please hit the like button and subscribe to our YouTube channel.